Hey everybody, welcome back to another episode. I'm your host, Brandon Cobb, and today I got Kirk Chisholm on the show. He's a principal and wealth manager, Innovative Advisory Group. They're an independent registered investment advisor located in Lexington, Massachusetts. Kirk's been acknowledged as one of the seven most influential financial advisors on Investopedia's top 100. And he was also named one of the top 10 social media all stars in the financial industry. We've got some really good stuff that I'm excited to dive into today. Kirk, welcome to the show.
Hey, thanks for having me on, Brandon. This will be a lot of fun.
Yeah, no, it's very I like the fact that you're fiduciary. Most people they don't understand the difference between like a financial advisor who's really just brokering products out there and getting paid for it and those who are a true fiduciary. So before we kind of jump into things, maybe explain the difference there to the audience.
Sure. Yeah, happy to. Yeah, when I started in this industry back in 1999, I started at a firm called Payne Weber, which is now UBS. They were acquired by UBS, and they're what would be considered a broker-dealer or a wirehouse at the time. You remember the names Merrill Lynch, Morgan Stanley, UBS. Those are kind of wirehouse broker-dealers. And those type of firms, um, they're really all about selling product. So if you want to buy product, you want to buy, something on commission, they're a great place to go. Now the industry has changed in the last 25 years, 26 years, in that people no longer want to go buy stock because anyone can do that. What they're looking for is advice. And so we set up our firm as a registered investment advisory firm or as a fiduciary. And a fiduciary puts your interest above my own, right? It's my job is to put your interest first. As a broker dealer, there's very limited interest that they have. You have to be suitable, but once they sell you the product, they don't have to ever call you again. That's the end of the transaction. Whereas a fiduciary, it's an ongoing relationship that we engage in for now until the relationship stops. Um, and so I like that model better because it allows me to work more closely with my clients to develop deeper relationships with them over time to help them and their family. It's a much deeper relationship and it allows me to put their best interests first and to develop that over time.
Yeah, it's a big difference. You've got their best interest at heart, essentially, and you're not just trying to profit. A lot of people need to ask that question when they're interviewing financial advisors. Are you a true fiduciary? Because there's a huge difference there. So, if you were, in an elevator and someone asked you what you do on your way from the 10th floor down to the first floor, what would you tell them?
Tell them I'm interesting. I don't know. It's a good question. I'm not. I do so many things. Ultimately it depends on what the context of the relationship is. Um, I run a popular podcast. Been doing that since I think the podcast's been around since 2014. Been advisors for 26 years. We do a lot. I would say the thing that bridges all of those structures is really what it comes down to is risk management. I help people with risk management, whether it's traditional markets with stocks, bonds, mutual funds, or whether it's wealth alternatives like real estate, hard money, horses. Whatever it is, we're really focused on risk management first because we believe that all good investments start with risk management first.
It's funny you say that because pre 2022, you didn't really need to have that lens. I mean, you could just throw money at any real estate and it was appreciated and everyone was making money. And then afterwards, we had the Black Swan interest rate revised. A lot of people got burned from it. It was kind of that reminder like, hey, risk management is important. How would you, how do you go into like pricing assets or pricing risk into assets? I mean, tell me more about, you know, managing risk and how you advise clients to do that.
Yeah, it's interesting. It depends on the asset, of course. Whether it's real estate or a business or a stock, it's all kind of a similar framework. Um, the valuation of it is one piece for sure. Another piece is should you even do it, right? So if I think of like let's just take a stock in the stock market because it's easier, it's simpler. We can add frameworks to the other alts. Um, but if you're looking at a stock, the first thing you're looking for is this something, why do I want to invest in it? Right? Doesn't matter. Maybe they're making AI chips and you're like, oh, okay, this is going to be the next best thing. Um, Okay, so that's why you want to do it. Then the question is, should you do it, right? Do you know anything about this thing, or did your buddy's sister's cousin's former roommate tell you? I mean, there was a time 50 years ago where inside information was special. Now there is no such thing because everybody knows everything. Like there's no such thing as inside information. Everybody knows everything. Like the information is abundant. Um, and so now you have to figure out, all right, where's my edge as an investor? Okay. Now, typically, your edge as an investor is doing the due diligence or the risk management properly first. So let me give an example. So if I want to buy a stock, right, let's say it's Acme Corp, and I want to buy Acme Corp stock, I'd look at it and say, all right, what is my potential for upside and what is my potential for loss? Now, most people look at the upside and say, wow, I could make 1,000%. It'd be great. No, it's practically you're not going to make 1,000%. I mean, if you held it over 20 years, but in the next year or two, that's not probably not going to happen. So, practically speaking, what are your expectations? I want to make 20% a year. I want to make 15% a year. What are those expectations, right? And whatever those are, all right, put a pin in that. Now you have to look at um, what is my probability of loss, or what is my not only my probability what is the potential for loss? Okay, so let's say the potential for loss is 15% loss, and then you got let's say 15% a year upside. Okay, so you pretty much have a 1-to-1. That's flipping a coin in my book. I don't really like that. Some people do. I don't like that because that's basically flipping a coin. What I would like is what people on Wall Street call asymmetric risk reward relationships. So, an example of that might be, well, I can make 15% in the stock, but my loss is 5%.
Hmm.
That to me is a great deal because the worst case I'm going to lose is 5%, and the best case I'm going to make 15. That's asymmetric in the favor of reward, right? Because you don't know the outcome. You don't know if you're going to lose or if you're going to win. You have no idea, right? Nobody does.
Hmm.
We all think we do. We all come to the table and say, "I'm going to make all this money and it's going to be great and all this stuff's going to happen and the seas are going to part and unicorns will be running through my yard." That's fine, but that's not reality, right? Reality is that sometimes bad things happen. You could have the perfect property that you just bought and COVID happens. You lose lots of money because you got to carry that property for a year. And the courts are closed. You can't even do anything with it. Things happen, right? You can't predict that. But what you can predict is, all right, what's the worst thing that could happen here? That is predictable, right? How can I minimize that risk? In the stock market, it's easy, or you can use things like options, which we do. And I could tell you, all right, I put up 1%. The most I could lose is 1%. The most I make is 3. I love that. That's a great scenario for me. Um, so that's a simple scenario. But when you're dealing with real estate, it's a little harder, but there's still some things you could do. Um, but realistically, what you're trying to do is you're trying to minimize the risk as much as possible. If you have that taken care of, the upside takes care of itself. That's the reality of most investments. If you do your research coming in, if you do your diligence, if you do the risk management up front, the back end takes care of itself. Because once you
Hmm.
invest, you're not doing anything. You're just watching and waiting, right? Assuming you're not running a business or operating real estate. But I'm just assuming as an investor, you don't do anything once you invest. The hard part is up till you invest, right? If you get that right, the rest is more in your favor than not because you've done all the hard work. You cannot know if it goes against you, but at least if it goes against you, say, all right, I've minimized it by doing A, B, C, and D. So the worst case, at least I'll get my money back. Okay, that's a good scenario. So that's how you should be thinking big picture about your investments. Is it any way, shape, or form you try to mitigate the risks? I know people want to focus on performance, but at the end of the day, it's the one thing you cannot control is performance. You can control risk. Warren Buffett's mentor, Benjamin Graham, actually was one of his quotes. He said, "You can't manage performance, but you can manage risk." Um, and there's a lot of truth to that, right? It's the way things work, but yet it's the one thing people don't focus on. So if you learn nothing else from today, if you learn that, that will do a lot for you.
So let's run it's two different asset classes, two different scenarios here because I'm interested in this. I think risk is very, very important. In fact, we kind of pivoted after 2022, and everything we do is probably borderline paranoia on like the risk and what could possibly go wrong. 'Cause in 2022, I mean, literally everything that could have gone wrong went wrong, and I mean, it was nobody saw it coming. You had interest rates double, go up the fastest they've ever gone since the 70s. You had crazy inflation causing the prices of building products and everything else in the construction world and real estate to go up. And then you couldn't get some of the materials because of the supply chain issues. I mean, it was crazy all the stuff that went wrong. So let's take a piece of real estate, for example. If I'm assuming I'm one of your clients and I'm coming to you and I'm saying, hey, Kirk, I really want to buy this piece of land. My um, my goal with this piece of land is I want to land bank it. I want to get it approved for 50 home development, and I just want to land bank it for a few years and then sell it later on. Let's walk through how you would have a conversation, with me about this particular type of investment, and then I got a second one that I think will be fun and interesting.
Okay, yeah, let's start. So Brandon, what do you know about land?
I've been doing it for almost a decade. It's our core business model. We do a lot of land entitlement, a lot of land development. Um, you know, building houses, built a lot of houses, and I found a pretty good piece that's in the downtown core of Nashville that we really like. And we've never land banked something before. We've always just entitled it and sold it off, or developed and sold the lots to builders. So this is something new that we're looking at doing.
Okay, cool. So you're experienced, right? That's an important component of this is you have experience in this, you've done it before,
Yeah.
you understand it, it's what you do professionally. It's not like you just heard this on the radio and said, "Let me just do this cool thing." Good. That's a good start, right? So there's an expectation there that you have a niche understanding of this, right? That's a really important piece of that is your level of understanding. Because if you don't have that, if you just said,
Mhm.
"Well, I want to invest in racehorses," and you don't know anything about it, I'd say you need to find an expert. And I could tell you, I'm not an expert. We do that for clients, but I'm not an expert, so I'm not the person you talk to about that. Um,
Okay.
so, okay, that's a good start. So the next question I would ask is, what is it about this land banking that you're not currently doing, but you want to do? Um, what is about this that is better and different than what you're doing now?
I've noticed over time we have these short turnarounds that are like, 18 months or less in these land entitlement deals. And I looked at all the past deals that we did and I'm like, holy cow, if I had just kept these things and held them, I could have 2x, 3x my profits in some
Okay.
scenarios. And I've been studying the business cycle and kind of where we're at with real estate. And I think we've been in the gutter for a little bit. I think, asset prices have really gone down. And I think there's a very compelling case that we've kind of reached the bottom of this cycle in real estate, this correction. And I think it's going to just go up from here. And I think I'm going to have better returns if I were to just hold this property after getting the approvals for a couple of years rather than just selling it quickly.
Okay, good. No, that's good. So, let's talk this through. So there's a few things. One is you're talking about, bird in the hand, verse two in the bush. And so there's an interesting aspect when it comes to investing, is that people are always looking for the next best thing, the thing that could make it better, which is great. We should all be looking for how to make our investing better.
Mm-hmm.
Um, and as you grow your experience, as you grow your skill sets, things will evolve. So, for example, when I started helping clients, we didn't use options. And then one day we started to, and it was great and it worked really, really well. And then I realized that the environment changed and I needed to change. My skill sets needed to change. So we changed our strategy for options into something different. And
Mhm.
then 6 months ago, we changed it again. And I learned a new skill and it's working great. Um, so I think there's always that aspect of this that you should always be looking for how can I make
Mhm.
this deal better? How can I improve this? But the other aspect you should focus on is what could go wrong? In doing this one thing, what could go wrong in a way that either I'm not expecting or has my risk increased? So for instance, let's say you're land banking it and you're getting like a 2 to 1, return to risk, and you're land banking it and it's it's either 2 to 1 or now it's 1 to 1. You're making more profits, but your risk goes up. So the
Mhm.
question you should ask is A, just because your profit's going up, is your risk going up? Or are there risks you're not aware of that now you're taking on, right? And understanding that new aspect.
Mhm.
It could be that the environment is great for this and the risks are reduced and all this, but you have to assess that new thing in a new risk environment.
Mhm.
Secondly, you should also look at it and say, how can I de-risk this? Now, here's something I do a lot with the traditional markets, and it's harder to do in alternative markets, but it might be true with land banking. What if you could do both? What if you could do what you are doing and do the other thing? Now, let's take the stock market, right? Let's say I buy a position and it goes up 100%. Well, I have a rule. If anything goes up 100%, I sell half, which takes my original investment off the table, and now I'm playing with 100% profits. I have zero risk.
Mhm. Yeah.
So I de-risked that investment. Now, yes, my upside is reduced because now I make, half as much upside, but I have zero risk. Now, if you play the game long enough, this is important. And, because you're going to go through, you mentioned the 2022 cycle. You didn't mention the 2020 cycle or 2008 cycle or like there's always a cycle, right? And this is how markets work. Real estate is notorious for this. And I think, um, fortunately, real estate has had a pretty good cycle for a lot longer than most people realize. But typically, you're looking at like a 7 to 10 year cycle, and the last real bad one was 2008. 2022 wasn't great, but it wasn't as bad as 2008. And so, the longer you're around, the more wisdom you get in the fact that there are always going to be bad times, and you have to prepare for them. It doesn't mean
Mhm.
you don't get excited about the opportunity, but you have to at least understand, look, I need to de-risk this as much as I can. I'll give an example. There's a guy I know. He
Mhm.
invests he invests locally in Boston, and he will buy properties and then he will rent them out. He's streamlined the process better than anybody I've ever seen. So he buys the properties, he gets a good deal on them just because he's in the area and he knows people, so he gets a good deal on them, and then he rehabs them himself, and then he rents them out to Section 8. So basically, he's guaranteed rent. And then and he also does a lot of diligence on the Section 8s that he gets. He's got some connections, so he knows the good tenants and not good tenants.
Mhm.
So he's de-risked every single part of that process. He's de-risking it as much as possible. Yes, there is risk. There's always risk, but he's reduced it. And so when he realizes that, hey, things are getting a little, the real estate cycle might be a little tough, he starts paying down debt. He starts paying it off, right? Um, Now he's not into the commercial units where it's 10-year loans, but if you own something for 10 years and you got 3 years to go and you're seeing the real estate cycle get a little dicey, you might want to start paying that down, right? As 2020 was a perfect example, 2022, perfect example when rates went up, and if you had to refi, you're toast. So it's important to have that time context of
Mhm.
how this is going to evolve over time and how the evolution of interest rates and market conditions and rent are all going to impact your investment.
Okay, so thinking through the risks of the investment, on this particular one, I'm acquiring it for 2.5. I'm going to put another 250,000 into it. When it's all approved and done, it's going to be worth probably around 3.8. And if I hold it for 3 more years, I think it will probably be worth probably 5 million at that point. Some of the risks are, well, I'm getting a loan on it. Normally these things are pre-sold and I don't have to get any loans on it, right? I pre-sell it. That's a lot of risk reduction. But I'm going to be getting a loan on it, and of course, the bank could probably call the note due if they um, get bought out by another bank or something happens. And so, if I'm looking for a 3-year hold, I'd want a 5-year term on my note. But I'm not sure how to reduce that risk with a bank getting bought out and just kind of calling the note due right there. So that is a risk that I'm currently trying to figure out how to navigate there. So.
Yeah, that's good to acknowledge that it's callable by the bank. In my experience, banks don't like to call stuff due if you're paying on time because all they really want is they want a loan book that's performing. That's all they really care about. They're not trying to maximize. I mean, if you're talking about like a JP Morgan size bank, might be a little different. But if you're talking about a local bank, all they care about is, are my loans paying, and what is the
Mhm.
potential for them to not pay? Now,
Mhm.
if you're dealing with a lender in the oil patch and oil has a problem, then you might have a problem. So don't just think about your property or getting bought out. It could be because I forget the name of the bank. It's like Frost and something, but there's like a bank in Texas that deals with the oil patch, and that's their primary expertise. Now, if you're using them and oil goes through a tough cycle as it does, then they might be looking to shore up stuff and they might move things around in a way you don't like. Um, so you want to have an understanding of your bank, of what they own, what kind of business they do. Um, you might also negotiate it with the bank. You might just say this is not callable by if you get taken over. You can negotiate. I mean, the one thing I love about real estate is everything's negotiable. Every
Yeah,
single
nobody
thing.
negotiates the loan documents.
You do. We do. We negotiate loan documents all the time. They don't want to and they don't think they can, but they can. So if they want your business, they'll do it. We have, because we deal with self-directed IRA stuff a lot. I will tell you that very few banks understand this, and
Mhm.
they all steamroll you and tell you have to do certain things. Like SBA lenders. Oh, you have to do this. Really? Why? Let me give you an example. So we had a business we were invested in with self-directed IRA money, so retirement accounts. And they were, owners in the bank. And the bank's like, well, we need their social security numbers. Like, why? You don't need them. They're not a 20% shareholder. They're like a 4% shareholder. You don't need their information. Well, we need it because it's required. No, it's not. First of all, no, it's not. Second of all, you're not getting their socials because they are not the owner. The IRA is the owner. And now you've got them confused. So we don't understand. Like, yes, I know you don't understand. Bring in your manager because clearly you're trying to just check boxes and not actually think. And
Huh.
so when you deal with banks, we deal with this a lot, and you really have to push the envelope with them because most of them are just checking boxes. It's just a machine. And if they want your business, they'll figure it out. Um, and so it's good to work local because you can build these relationships with people who want your business.
Mhm.
And the more business you give them, the more they want it. So because that development, that risk, that they get to know you're low risk, and so they want to do more stuff. So if you're dealing with that kind of a bank, you can negotiate everything. Most of them say, well, it's recourse loans. No, I want a non-recourse. It's a retirement account. It has to be non-recourse. I cannot have recourse to myself. Well, it's required. No, it's not required. It's something that you can decide to do or not do. So everything's negotiable, no matter how much they say it's not, it is. It might just mean that you have to do more searching to find a bank, but everything is negotiable. Don't
So
like.
these are the types of conversations you're having with your clients. Like hey, I'm thinking about investing here. Let's sniff out the risk. What could go wrong? How could we mitigate it? Like these are the types of services that you're offering as like a fiduciary. Like this is where you add value.
Yeah, I mean, think about it this way. It's like if you're negotiating real estate, right? The two things you can negotiate in real estate are price and terms. You
Hmm.
choose one as long as I get to choose the other. You can choose
Yeah.
you want price, whatever price you want, as long as I get to choose the terms. Oh, you
Yeah.
want five times as much for the price? Sure. I'll pay you over 300 years. Like,
Yeah.
I mean, you can figure it out, right? Everything
Yeah.
is figure outable, but I think the key is when you're going in, you can't assume anything is static. You have to look at everything as a flexible entity and say, all right, how would I do this? You have to be creative, right? You have to think through, all right, if I'm in the stock market, there are things I cannot change. The company is not going to make a change for me because they can't. It's the same for everybody. If I'm using options, I can't negotiate a different option. It's the same for everybody. They're
Mhm.
fixed. Now I can choose my price. I can choose the different kinds of risk management tools I use around the price, but everything's static. That I cannot change. With real estate, everything's changeable.
Mhm.
But that being said, it might require negotiation, right? Price and
Yeah.
terms. You might decide, and this happens a lot with real estate investors, is they'll buy a piece of land and they'll say, "All right, I want to buy this land, but instead of me buying it, um, I'm going to bring you on as a partner while I develop it." And so they're taking zero risk in the whole process, and the owner still buys it. The owner gets a piece, they get a bigger piece because they're sticking around while it's developed. But me as the contractor, the developer, I don't put any money up because the owner has the money. And all I'm doing is paying for whatever the development costs, which sometimes are larger, sometimes they're smaller. But I pay for that, but I don't have to pay for the land. Well, now my risks are really small because if
Mhm.
I find something I don't like, if I find out like 5 weeks in that, oh crap, there's a toxic waste dump here I didn't know about. All right, cutting the cord, sunk
Yeah.
costs, I'm done. And now you have a small loss instead of a big loss. So real estate investors are good at this, because there's so many flexible things you can do.
Mhm.
Let me give you an example of something I did. Okay. Um, Back in 2009, after the financial crisis, I think it was 2000. Yeah, 2009. Yeah, I think it was 2009. Um, I don't know. It was 2003, 2009, one of those two. But it was basically after one of the big crashes. So I was learning about, yeah, I'm sorry, it was 2003. That's what it was. So after
You
the,
talking about the you talking about the where Bear Stearns went bust
no, no,
and
that was
Lehman
2008.
Brothers?
That was
Yeah. Okay.
2008. No, I was trying to remember when I did this, but I think it was 2003. So back in 2003, it was after the tech bubble burst and basically the economy
Hmm.
was in the dumps and we hadn't gone to war yet with Iraq, but we were just before that. And everyone lost a lot of money. Now, I had learned about these government auctions, right? And so I was perusing through the government auction sites, and there's a lot of junk there. There's a lot of stuff that just had no interest. But I found one parcel local to me, because most of the stuff was in like Texas, and I was like, I'm not doing that. But there was one local to me. Okay, it was about 45 minutes from my house. And Massachusetts is notorious about not having a lot of deals because there's a lot of Sharpies picking stuff up. But there was this one parcel, and I was like, oh, interesting. Let me check this out. So I drove out there, I checked it out, checked out the lot maps. I'm like, wow, really interesting. And so I saw this parcel and I was like, wow, I can get this really cheap. The land's probably worth maybe like 250. I probably could have got it for about 50. Um, but I don't know if it was buildable, right? It was just land, right? And it was behind somebody's house, so I would have to have an easement to it, which there was. So there's all this stuff I had to look into. And I'm looking at it, I'm like, all right, what's my risk here? Now, I had put down $100 to lock it up, to lock up the deal. And it was with the government, so they weren't negotiating very hard. So I think I got it for 50 and I put $100 down and I need to put 5 grand up for the P&S. So what I did is I put the $100 down to lock it up. I locked it up for like 60 days, just told them, hey, I got to get this stuff taken care of. Um, and they said, that's fine. So I used that time to do my research, to go in there. And what I was trying to do is I was trying to sell the property as quickly as possible. For $100 down, I was seeing what's the most I can make on this property. because no one
Hmm.
else, no one else was there. We had neighbors. I was talking. What I do? I go to the neighbors. I say, hey, I got this property. Do you want to buy it? It's right in your backyard. It'd be a good idea because I'm thinking of building a pig farm back here and it's going to stink. And so I made all these assumptions with them, and I said, is this something you want to buy? And they're like, yeah, we're interested. And so, went back and forth with them. I talked to a cell tower company because they had a really bad cell reception there. I was like, oh, I should put a cell tower here. Of course, the neighbors didn't want to hear that either. And I said, well, this is what I'm planning on doing. You guys interested in the property? And so I got some people interested, and I only had $100 down, remember? And I was trying to flip the property, and I had all this stuff lined up beforehand. So then, if I decided to press the button and put money down, I would have had it all locked up. Now, I didn't end up going through with it because I didn't have the people locked up by the time it ran out, and I didn't want to put up 5 grand. And I was happy losing $100, but I wasn't happy losing the 5 grand because
Yeah.
there was some risk in the deal. So I backed out. But my whole point was is I was trying to do as much as possible with as little money as possible. And my worst case scenario is like, you know what? And I told the guy at the end, I said, look, man, you don't want to do this, that's cool. But if I don't take it, someone else will, so you might want to grab it. And I don't know if he ever did because he just seemed like he wasn't motivated, but I know somebody would eventually grab it. So I just
Hmm.
wasn't going to sit on it for 10 years, which is a certain
Right.
possibility that could have happened.
So real estate checks the big box, I think, which is the asymmetric returns, right? Just real
Yep.
estate is not known to going to zero, right? It's got some kind of intrinsic value, building, land, and so that kind of checks the box. Let's go into something a little bit more interesting. So, same situation, I'm your client and I'm wanting to buy some crypto. How do
Okay.
we talk through something like that? Because it's completely different than real estate.
Yeah, that's a great one. So we do a lot with crypto. So we invested in Bitcoin back in 2017. So that's when I started. Um, and my whole thesis around crypto is so there's a few different aspects of it. Um, let's talk about Bitcoin for a second, and we'll talk about some other frameworks. Because everyone understands Bitcoin, right? Bitcoin is it's the granddaddy of them all. It's
Hmm.
the basis for all the rest. Um, and it has the most clout and it's the biggest. So um, when I look at Bitcoin, I look at it in this way. My lens is somewhere around a 4-year cycle, give or take. Um, it's probably going to go up a few 100% and it's probably going to crash 70%. So my thesis about Bitcoin is I buy it when it's cheap and I ride it up and it goes up 100%. I sell half and then I keep the rest. And the next
Hmm.
time it crashes, I wait. Like right now, it's down 50 some odd percent. I'm waiting. If this is the bottom, I'm okay missing it because I still have it from before. But I'm not buying until nobody wants to buy it. And right now, everyone's trying to buy it. They're trying to buy the dip. Bitcoin, you don't buy unless nobody wants it. I mean, people are bottomed out. They've lost all their money. They're like, screw this. I'm out of here. You want people to just be disgusted with the asset before you buy in.
Hmm.
So Bitcoin's not there. We're probably 6 to 12 months away from that, if I had to guess. So if that's the case, I'd wait till nobody wants it, and I'd say, okay, this is a good time to start, and then I would wait till it starts to actually pick up some interest. Because if you look back, I think it was 22. I have to look this up, but if you go back to, I believe it was. I'm going to pull this up while we're on it, just because make it easier.
Previous peak.
Yeah, so if you go back to okay, it was the end of 22. Okay. So the end of 22, we bought it December 31st because what happened was all of 22 it went down and then it flatlined at the end and then in December it started to really go down more. That was what we call tax loss selling. So in the markets, a
Mm.
lot of tax loss selling happens around December where people just
Yeah.
say, I'm going to take the loss, I'll buy it back 30 days later. I said, great, I'll wait till December 31st. I'll buy it. And then if January 2nd it keeps going down, I'm out. But it didn't. It popped up January 2nd and said, all right, that was the bottom, or at least close enough to it. And then, we added more positions as it went up. That's how we manage risk with crypto. Now, we sell half when it goes down. When it goes up 100%, we sell half so that we take all of our risk off the table.
Mm.
I also acknowledge the fact that I'm not perfect on my timing, and if when I get in, I look at it and say, all right, if it hits a position lower this, I'm out. I'm not. I'm looking to build long-term positions, but I am not going to ride it to the bottom. Here's what happens in crypto. Okay. If you look at what's
So real
happening
quick with that first kind of step here, you're looking at it through past performance, going, okay, what are some of the patterns here? Okay, 4 year cycle. I see historically the best time to buy it is when there's capitulation and nobody wants it, and you're kind of paying attention more to market sentiment in the 4 year cycle rather than I guess that like
fundamentals.
asymmetric framework with real estate.
Yeah, so the problem with crypto is there's no fundamentals. So you can't invest in fundamentals because there aren't any. It's basically a technology that everybody agrees that is going to get better and better over time. That's it.
Mhm.
There's no value there other than what other people ascribe to it. Now with real estate, there's cash flow, there's legitimate use you have. You can live in it, you can rent it. Crypto, there's no use case. People say, yeah, 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 people transfer money, but in reality, everybody's gambling on it. That's the reality of it. So you have to understand what it is you're investing in. No, I don't like crypto. I think it's basically gambling, but it is predictable enough where I would. Here's another framework I think is useful. So I think what a lot of people do when they look at crypto is they see the lottery ticket. They say, this is going to go to $10 million because Michael Saylor said so. I can buy it for 50 grand and I'm going to make a bazillion% return. Awesome. I'm going to be a bazillionaire. Yeah, that's nice, but that's not realistic. Okay. It's not going to go to $20 million anytime soon. It's more likely to go to $20,000 than it is to 20 million in the near future. And so what people don't recognize is the time scale that's applied to this. Okay. Now, what people also do is they say, well, in order to be a millionaire, I need to put like 50% of my wealth into this thing, which is totally insane. Because if you're looking at crypto, it could just as easily go to zero as it could to 20 million. And if you don't believe that at your core, you're making a mistake because this is where the sunshine and rainbows and unicorns comes in is everybody thinks it's they're going to win and they're going to make lots of money. I get it. That's why you invest, right? You're an optimist. However, if you can't put into context the risk, and the risk in crypto is it goes to zero. That's a risk. There's a risk
Mhm.
it goes to zero. People are going to say, well, it's probably not going to happen. Doesn't matter if it's probably not going to happen. Could it happen? Yes, it could happen. Okay, so if it could happen, you have to ascribe that risk to your investment. It could go to zero. Now, real estate probably won't go to zero. There's things like U.S. Treasuries probably won't go to zero. It's the least risky thing out there is U.S.
Mhm.
Treasuries, but there is a risk. The
Right.
U.S. government could default. It is possible. Very unlikely, but possible. Real estate, I mean, could go to zero. What happened to the Palisades? What's that worth? That's worth close to zero. So, look at Hawaii, where the fire went through. That's close to zero. I mean, I'm not saying that real estate's going to zero, but you have to understand that there are always risks. And you have to, when you're looking at your investing, you have to assume that that risk is there. So, for instance, if let's say I've got a $100,000 portfolio to make the numbers easy, right? I take a percentage of that portfolio, right? And let's say I'm using, most people look at like 20 or 50%. I'm looking at 1 to 5%. And I look at it and say, all right, if this goes to zero, what is the most risk I'm willing to lose? What is the most portfolio percentage I'm willing to lose? Now
Mhm.
think about this for a moment. If I put in 5%, that's a bad day, but I'm going to be fine, right? If I put 20%, that's a bad year. Okay. Like 20% is a bad year. 50% is a bad decade. So, if you have 1%, that's a bad day. The markets go up and down 1% in any given day. If I lose 1% in crypto, who cares? So you can invest in crypto. Anybody can, no matter how risk averse you are, but it comes down to the percentage allocation. It might be 0.1% of your portfolio if you're really risk
Mhm.
averse. I'm not suggesting everybody do it, but I'm saying that you can, depending on your tolerance for risk, that could be dependent upon the percentage your portfolio put in, right? So real estate is hard to do that because it's so expensive. Unless you're, decamillionaire, you're going to have, you're probably going to have one property to start, and then two, it's hard to diversify. But in the markets, you can, because I can buy one share, or I can buy a very small percentage or partial share. So with crypto, one of the other things I do for risk management is I tune up or tune down the percentages in the portfolio based on what's going on. And so I don't, if I put in, if the market's bottomed out like it was 2022 and I put like 5% of your portfolio in it, I'm okay with that. But I also have a very hair trigger response where if it keeps going down, as I mentioned, January 2nd or 3rd, I'd be out um, because it wasn't going in my direction. But once I take my profit out, then I have no risk and I don't really care where it goes. And I can keep it
Mhm.
forever because I have no risk. Um, so there's a lot of ways to think about your assets. You can
Mhm.
think about it as a percentage of the total. You can think about it in a per asset basis. You can think about the underlying. You asked about crypto. How do you assess crypto? Well, part of it is assessing the technology. Like Bitcoin is a standard technology, but it's not perfect, and it's pseudonymous. It's privacy. Like it's not really private. Everyone can see it, so there's no real privacy there. I don't love it as an asset because of that. I want something that's total privacy. I don't want anyone to see what I'm doing. If I'm buying and selling at the store, I don't want people to see that. So
Mhm.
Bitcoin is not perfect for that. Ethereum's great, but is it going to be adopted? Hope so. Maybe. I don't know. Solana, all these, you got the shit coins, you got all these altcoins, you got all these coins out there. I don't, I'm not an expert in all of them, so, and I don't prescribe to be. But if I'm not an expert in that technology, that is how I would go about assessing the risk is how do I reduce it, not knowing the asset, because 99.9% of the people are not going to have a foggy clue on how this technology works.
Yeah.
And that's
Yeah, I
okay.
like I like what you said there. It's analyzing the past performance of the asset, looking for trends. Okay, Bitcoin have identified this 4-year kind of cycle. We know to buy it when there's a capitulation, and you kind of de-risked it when you said, okay, as soon as it goes up 100%, because we noticed it goes up like 600%, on the bull markets each cycle. Like as soon as you get to 100%, 50% out, done, and then you've kind of de-risked what people would call an asset that's pretty far out on the risk curve there by just get your money back, original investment as soon as possible, and then the rest is just kind of gravy on the upside.
Yeah, I mean, ultimately, when you look at all of these things, you have to have in mind your exit strategy first. And what I would say the hardest thing well, I'll give you 2 points. One of the hardest things I've always had is what is my exit strategy before I go in? So you always go in saying, this is why I'm going to invest. Here's my thesis. It's great. But if you also don't have, here's my exit strategy, then you're making a mistake.
Mm-hmm.
So if you're in an illiquid investment, you don't have an exit strategy. Now, the if you're in like a fund, the fund manager may tell you the exit strategy, and you have to be okay with that, right? So if they say, well, we're going to liquidate in 5 to 10 years, and here's the target, okay. Do they have a history of liquidating, or do they just sit on it and just keep the fees going every year, right? Because some like non-traded REITs do that. Is they'll say, "Oh yeah, we're going to liquidate in 5 years," and you look at their track record; they've never liquidated a fund. They've got like 20. So you have to understand like what's the exit strategy, and also because there are bad years out there, like 2008, 2020, like all these times. Like I remember 2009, I was getting called from random people that I didn't know who were saying, "Hey, I've got this non-traded REIT. Can you help me get out of it?" I did some research and found some marketplaces that were buying them for like 5 cents in the dollar. I was like,
Huh.
wow, this is a great opportunity. These things are worth probably 70 cents in the dollar, given, the real estate declines, 70 cents, but 5 cents in the dollar. I was like, I don't have enough cash for this. Like, I need a lot more cash to do this because this is great. Um, but you know, you have to understand that sometimes the liquid assets, there's an illiquidity premium that comes on, which means you should be getting paid more for an illiquid asset than you do for a liquid asset. So one of the things we do a lot of alts, but one of the things I like about the liquid markets is that I can cash out anytime. If I think the world's going to end in a week, I can just liquidate and put it all into cash right now. I don't have to worry about it. And I can get back in
Hmm.
if I'm wrong. But if I'm in an illiquid asset, I got to ride it out. So there's nothing wrong with that. You should be getting paid more for that, though. Your return should be higher for illiquid assets to pay you for that illiquidity. Because there are times where, like COVID, when COVID happened, people were stuck. A lot of real estate investors were stuck. And if you didn't have a big buffer, cash buffer, like 6, 12 months cash buffer of rent, you can be in trouble.
Yeah,
Um,
gyms, gyms, restaurants that operate
yeah,
on like a couple months cash flow, all just shutting doors. It was wild. Yeah.
yeah. Too many businesses run on very little buffer. As
Yeah.
an investor, even forget as an investor, as a person, you should always have an emergency fund of a certain amount that makes you comfortable. Now, that depends largely on your business. It depends on what kind of business you run. Like if you're like my business is pretty repeatable business and it's pretty resilient. The only thing that would kill my business is poor performance. Um, Good times, bad times, as long as we do it right, we're fine. Real estate business, like a restaurant, a lot of restaurants closed during COVID because people couldn't show up.
Yeah.
Real estate is generally pretty resilient because people have to live somewhere. But some people got stuck in COVID. People decided not to pay because they weren't getting paid, so they couldn't pay you. So COVID's it's a black swan event that I would suspect will never happen in our lifetimes again. But things happen, right? And this is why you can't always prepare for all outcomes. Um, I was prepared for 2008 because we had we talked to a lot of people and we were aware that that was going on. We didn't know how bad it would be and we didn't know when it would happen, but we knew it was bad. So when you see these things, you can prepare for them, but you have to be really careful because there's a lot of times where you're not prepared. And so the thing that a lot of people make mistakes about is they're not. Um, a lot of people get overinvested. So a good example would be real estate investors and oil investors, oil and gas. They suffer from the same attributes. Is what tends to happen is in good times and boom times, they lever up and go all in because everyone's making lots of money. Real estate is was like this before 2008. I haven't seen a lot of people do it since, but 2008, like 2000 to 2005, 2005 was the peak. People were doing stupid stuff. I mean, you saw them in the movie The Big Short. Really stupid stuff. Oh, I have 20 houses and I have no equity down in a ninja loan, and like, what are you talking about? It
Yeah.
always goes up. Like that was stupid. But if you were stupid in the initial part and then you got out, you did fine, right? So, but the problem is people don't do that. It's like gambling. Like, oh, I'm winning. I'm not going to stop now. And, unfortunately, it's illiquids. You have to stop now, like at a certain point. Oil investors do the same. They're wildcatters. They keep hitting, and then times are booming. Oil's $100. Ooh, we're all making money, and then oil crashes to 25 within like I think it was like a month and a half, whatever year. That was
Yeah.
2017. It was crazy,
COVID. Yeah.
and people were like, "Oh crap."
Yeah.
And they
Yeah.
were they were toast. They were bankrupt. So the smart investors, the ones that stick around for many cycles, are the ones that are always prepared. They always have one foot out the door. It doesn't mean you don't maximize your money. What it means is you're always prepared for a leg down that you're not prepared for. You always have to have dry powder, always. If you don't have dry powder, you don't have access to it, you're in trouble. That's really the truth of it. And you really do have to get your stuff together if you want to be an investor or a speculator. A successful speculator lasts through big cycles because the reality is, if you can survive a bad cycle and you got a bag of cash and nobody else does, you're going
Mm.
to make your lifetime nut in that bad cycle. That's where you make
Yeah.
your money. And I'll just, before I give it back to you, I want to leave on this one point is that um, there's a concept that most people don't realize, and I'll use the stock market as a framework. everybody tries to beat the stock market on an up year. It's really not sustainable. It's really not doable on a year in year out basis. Now, in any given year, about 75% of the years the market is positive. 75% the market will be up. 25% it'll be down. And a handful of times, maybe 3 to 5%, it's bad. Okay, out of 100 years. 5%, I think, would be bad over 100 years. So knowing that, okay, if you're trying to beat the market on an up year, when the markets get really bad, you're gonna get cleaned out. Okay. Because you can't beat the market on an up year and not lose big on the downside. It's just how
Hmm.
markets work.
Yeah.
Like if the market's up 20 and you're getting 50, it means you're doing some stupid stuff. Like, and it could be profitable for you, but it's stupid when the market turns because it's going to hit you twice as hard because it means you're probably using leverage and other things irresponsibly. Um, now, what tends to happen is I don't try to beat the market in any given year. If I'm close, I'm fine. If I'm underperforming, I'm fine. My key to success is when the market goes down 50, I'm down 5%. So think about it. You're
Yeah.
down 50. So you own a share at $100 and it goes from $100 to 50. I'm sitting on a bag of cash. How many shares can I buy? I
Yeah.
can buy 2 shares. So my cash went up 100%. I made 100% of my cash because I didn't lose like everybody else did. Now I can buy twice as much. So the key to real big wealth is to find times where everybody is just getting creamed and people are just crying to get out of positions. And that's when you come in and say, I'll rescue you for 5 cents in the dollar. And that's where you
Yeah.
make your big money. You
You
don't
can.
it doesn't mean you don't make money in good years. You do, but you don't have to like be a rock star in the good years. You be a rock star in the bad years. That's how you make your money. If you talk about all the people who've been uber wealthy over time in like history, not recent, but like in history, it's people who just came in like Joe Kennedy, right? He made all his family's wealth because of the Great Depression. He got out at the top and he bought cab companies, he bought the essentials, and then, of course, he got into liquor. But even prior to that, like he was buying cab companies. What business is going to survive this? Cab companies.
Yeah.
So not only did he survive, but he kept making money. And then, of course, he got into more profitable endeavors. But that's the key to success over long term is to make sure you don't get cleaned out. But not only that, but you're in a good position to make money when times are bad because then, like 2008, I was driving around Miami where there's cranes everywhere, and I was looking at these 100-unit towers completely empty. In night, I was driving around at night, and there was like 3 units with lights on out of 100 plus units. And I was thinking, all these are probably in foreclosure. What if I could buy this building for like 10 cents on the dollar?
Yeah.
And I'd sat on it for 5 years. The problem was I didn't have enough cash.
Yeah. You got
We
to have
just,
cash.
yeah, we just
Yeah.
started our company. We didn't have enough. We had investors, but we didn't have enough. And we have plenty now, but like we missed the
Yeah.
opportunity, right? So that's
So
one of the keys. You got to have the cash when nobody else does.
last question for you, and I want to wrap up and let people know where they can find you and learn more about your services. What's your favorite alternative investment and why?
That's a great question. So there's really two, well, there's three that I love. Real estate is, in my opinion, the best asset out there in the alternative space. You get leverage, it's essential, it's got all the stuff you'd want in an investment. Real estate is, but in the subcategory real estate, my two favorite are um, hard money loans and tax liens. I love tax liens. I started getting involved with tax liens in the aughts, and I really wanted to dive in deep. The problem is the numbers. There was a time where you could make 12, like 10 to 15% with virtually no risk. I mean, what I love about them is there's virtually no risk, and I could talk about that if you want. But as of 2000 and I think it was 2008 or so, 2011, the yields were basically zero because all the institutions just wanted to put money in paper. They just needed paper. They didn't care what kind of paper. So the yields went down to zero and it didn't make sense anymore. But back before the institutions got in, it was awesome. It was like literally close to zero risk. It was one of the best investments I've ever seen, in my opinion, but now they're priced out of the market, so I don't touch them.
I love it. I love it. So hard money lending is kind of your go-to right now. I know you guys do a lot of that as well. So if people want to learn more about you, Kirk, learn more about your services, where can they go?
Yeah, so I'm pretty easy to find. I'm all over the interwebs. I have a podcast. Actually, you were on my show. It was a great episode. You did a great job. People should listen to that too. So I have a podcast, Money Tree Investing Podcast. We've been doing it since 2014, doing it for a long time. Have tons of guests. We do it twice a week. One's live. We talk about the markets. The other one is guests, like having you on. And it's a great way to learn. It's a great way to hear different opinions. Um, that's probably the best way to get to know me. I'm pretty easy to find. My company's innovativewealth.com. We're financial advisors. We do lots of interesting stuff. And yeah, if you just want to learn, you can go to the podcast. If you want to talk to me about investing, just go to innovativewealth.com.
All right. Thanks for sharing all the gold nuggets. And if you're listening to this right now, show Kirk some love, show me some love. Share this episode with a friend or family member that needs to hear it. Like it, and we will see you guys next time. Kirk, thanks for coming on.
Yeah, thanks for having me, Brandon. It was a lot of fun.